Good morning, good evening. Good evening. Prophet Iswa, please shout me if you can hear me very well. Prophet Iswa, shout me.
I can hear you good.
Thank you.
Yes, I can also see your screen.
I also see my screen. Thank you very much. It's nice having you as a host.
Thank you, sir.
No problem, ma'am. Okay, let's give like 2 or 3 minutes. Let's start the class by the next 3 minutes to allow some people to join, being the first day. To allow some people to join, being the first day. Okay, let's go to 1 more minute. And the last minute, 9:06, we shall start. We shall start when it is 1 minute more. What are you finding for? What are you finding for? Okay, let's start. Good evening, everybody. Welcome you to FCA platform online class. Yes, I know. Okay. We have so many things to do in the next 4 weeks. But before I continue to what we are going to do, this exam can come in video form. That number one question. There are like about 11 areas where group can stand. After so many research and analysis and discussion with experts and colleagues in the field, we come up with this area that we are going to try to focus on. Normally we will do the simple group, which will start today, the fellow subsidiary, then fellow subsidiary with equity transaction, piecemeal acquisition. That means acquisition you acquire in stages, disposal of subsidiary, and group cash flow. By God's grace, I will join my faith with your own faith. We have been praying and begging God that one of those areas should be the target for this diet, that ICANN should go to that area based on analysis. So please, be rest assured, you can ask me any question. No question is. So let's start with simple group. But before we start with simple group, we all know some certain definition concerning group account. By saying it's the account of the parent and subsidiary present and prepared and presented as if they are a single entity. That's one of the problems of the adjustment. They are not single entity, but the adjustment of a single company is different from group. Okay? What I mean by that, you will get to know it very well as we progress. Secondly, we are talking about investment here. The investment we are talking about is what we call shares investment, equity investment, shares investment. This is what we are talking about, equity shares, shares investment. That is what we are talking about when we talk about group accounts. We are talking about the shares investment. Now, if I have investment from 1% to 19%, that is a simple investment. If I have investment, that means I have a shares that range from 1% to 90%. It's a simple investment. How do we recognize simple investment in a group account? Or what is the implication of simple investment in a group account? Two things need to be understood in that area. Simple investments. For simple investment that start from 1% to 19%. Now, they are all financial instruments. Majorly, all those investments are known as what? Financial instruments. We now have types of financial instruments. It could be financial assets, could be financial liability, could be so many available for sales investment. They may give them so many names. Just like as you have your phone, we have different types of phone, different products, ranging from iPhone, Nokia, Infinix. This is the same way. That all those simple investments, they are categorized as what? Financial instruments. And all the other financial instruments, we have so many. Even under Nokia, you have so many products under Nokia. This is what is applicable there. Now, how do we account for standard under that place? How do we account for it? What are the standards that are linked to that financial instrument? Investment between 1% to 90%, which is known as simple investment or ordinary investment. We have IFRS 9, which is the major one. IFRS 9, which is the major one. How to measurement and recognition. IFRS 9. IFRS 9 now says it can be measured in two ways. It's either fair value through profit or loss, fair value through other comprehensive income. Now, if it is fair value through profit or loss, no more story, no more issue on that. But if it is fair value through other comprehensive income and the investment change hand, that place must, anything that you have reported in other comprehensive income must be debited and credit return of the parents. Let me come back again. Under the simple investments, the major thing in that particular place is IFRS 9, measurement and recognition of financial instruments, which can be done in two ways: fair value to profit or loss, fair value to other comprehensive income. If it is fair value to profit or loss, no issue. But if it is fair value to other comprehensive income, anything reported in that place, anything reported, if investment change hand, what my investment change hand means, if it's from simple investment to subsidiary, and you are reported anything other comprehensive income, anything you have reported there must be the one debited and credit to return of the parent. We are still coming to a question like that, which we are going to see practically. Then if I have investment between 20% or to 50%, what type of investment is that one? It's an associate. An associate. But we have 50%. Joint arrangement, IFRS 11, classify joint arrangement into two ways: joint operation and joint venture. In that sense, joint venture must be accounted for using equity method. So get those parts. Associate and joint ventures, they are similar. We use equity method to account for them, which is IAS 28. Now, if I now have investment from 51%, where that is the date of acquisition, where control starts, or to 100%, then we have what? Subsidiary. From 51% to 100% acquisition. When there's 100% acquisition, no NCI. That means non-controlling interest does not exist. Therefore, that is the basis of what we are starting today. Simple group. Parent with one subsidiary. First, to lay the foundation. Parent with one subsidiary. Group account is account of parent plus subsidiary plus or minus adjustment. I will now be demonstrating the adjustment, telling you what to do, and give you the different scenario on it. And if you have looked at my solution, you will see how I have done it to make it easier. Now, what are the accounting standards that apply to subsidiary? Accounting standards that apply to subsidiary, we have IFRS 3, business combination, is the one that talks about the acquisition method of acquiring. We have different method of acquiring. We can acquire through cash, deferred consideration, contingent consideration, so many ways we can acquire. That is one. So we have IFRS 10, which talk about the control. Control must talk about so many things. IFRS 10. Then we have IAS 27, separate financial statement. It's no longer interested in the company. It avoids its disposal. IAS 27 will talk about disposal or subsidiary in linking with IFRS 10, when control is lost. Those are the major aspects of group, those standards related to group accounts. Now, not to bother you with so many things, as we're going to be applying it in a practical way to show you how it is being done. Let's start on the simple growth. Now, immediately in exam, they give me a question. The question contains P or L and statement of financial position. It contains P or L and statement of financial position. They've stated P or L and statement of financial position once. Majorly, they normally say statement of financial position. And they said P or L alone once, making 2 times they said P or L. Now, if they give me a question that has P or L as statement of financial position, I will determine what type of investment do I have in my hand. I'll first of all determine the type of investment I have in my hand. And I also establish in the question there is no disposal. It means when I give you the question in exam on September 15, please endeavor to read all the question to know the type of investment you have and there is no disposal. So if there is disposal, you know what to do. We are still coming to disposal subsidiary by God's grace. Now, they give me this question now in exam. On April 2017, Aya Limited acquired 60% of the equity share capital of Lower Lower. I've established Lower Lower is a what? Subsidiary. Who is the parent? Aya. When does he acquire? On April 2017. When are we consolidating? That is the next thing. Date of acquisition, 1st of April 2017. When am I consolidating? I check I don't need to go to the requirement. I look at the heading, September 30, 2017. Something rings in my brain. April to September. Is it up to 1 year? No, it's not up to 1 year. That is what? Doing the year acquisition. That is what? Doing the year acquisition. Acquisition that comes after the subsidiary has started business operation for that year, financial year. It could be 6 months, it could be 4 months, 5 months. It must not be less than 3 months, according to the standard. So doing the acquisition start from 3 months and above. It could be 6, 8 months, 7 months, no problem. You acquire during the year. Now, having said that, I will now ask the question, how many months from April 2017 to September 2017? 6 months. Nobody said I should not count hand in exam. I can decide to count my hand. April, May, June, July, August, September, 6 months. Okay. When it is doing the acquisition, no retain any. Nobody will give you retain any when it is doing the year acquisition. When it is doing the year acquisition, no retain any at the date of acquisition of the subsidiary. They will not give you. You have to determine your retain any at the date of acquisition, which I will show you 2 ways to go about that. Okay. Now, how does he acquire the subsidiary? Because I say, okay, 60% equity share of capital, blah, blah, in a share exchange of 2 shares in higher for 3 shares, or you use share consideration in lower. The issue of shares has not yet been recorded by Aya Limited. At the date of acquisition, the share had a market value of 6 naira each. Always remember that the share consideration, it must be issued at the market price of the parent. If they're giving that of the subsidiary, no go there, nothing concern you with that of the subsidiary. It must be issued at the market price per share of the parent. Nothing concern with the subsidiary, is the parent. I haven't said that. Let's treat this information here. 60% the group structure, the cost of investment, share consideration. And if you look at the share consideration, okay, it said the issue of the shares has not yet been recorded by Aya Limited. You will not see as part of the cost of it as the investment in the statement of financial position. Let's go to the statement of financial position. You will not see, say it has not been recorded. You will not see investment here. It has not been recorded. It is my duty now to record it. The accountant does not know what to do. I will not tell him what to do. I will record. But if I'm recording it, I'm applying IFRS 3 business combination, where it's supposed to debit and credit according to IFRS 3 business combination acquisition method. That is what I will do. Okay. Having said that, okay, let's go back to see what I'm saying. Follow me. It's very simple. I'll go ask the question. Okay, I must convert. He acquires 60% shares. What is the numbers of shares that make the 60%? No issue. I'll just go to the financial statement one time, look at the financial statement. In short, within my 15 minutes reading time in exam, my 15 minutes reading time, I will be analyzing that. Okay, 128,000. He has a shares of 127 with the nominal value of 1 naira. Out of this 128,000, you convert it to unit of shares. You now multiply by the 60%. Okay. Let's see. Now look at the question. This is it. TNS, when date of acquisition to date of consolidation from April 1st, 2017 to September 2017 is 6 months. Total number, TNS, total numbers of shares in subsidiary, because I've determined they say 60%, the group structure, equals to values of shares, the value in the book value in the statement of financial position, divided by the nominal value. 128,000 divided by 1 naira will give me 128,000 naira. The share acquired by the parent, he acquires 60%. The 0.6 times 128,000 will give me 76,800. This 76,800 is the total shares he acquired. But he said he will issue additional shares because he doesn't have money to pay to the former shareholder. Okay, what is the rule says? It must be parent first over subsidiary because the parent is bigger. But irrespective of any question, when it is share consideration, always know that it is parent over subsidiary. Always know it's the parent over subsidiary. How many is the parent bringing? Exchange ratio. You will see in the statement of in the question. Share consideration can come in 3 ways. 1, exchange ratio, like this one, issue direct. And 3, market capitalization. But they've given me the exchange ratio, parent over subsidiary. They say parent will bring 2, he will collect 3 times the share he acquire, 76,800. But you now give me what? 51,200. This 51,200 is additional share he created as a result of acquiring the subsidiary. This is the total number of shares he acquired, but through the share exchange, he created additional 51,200 to himself. Okay. Well, it must be issued at the market price of the parent. What is the market price of the parent? 6 naira. So I will now say cost of investment now to be debited. 51,200 times 6 naira. This will go for my goodwill calculation. 307,200 debited to the goodwill. Equity shares, credit, 51,200 times 1 naira. The nominal value of the equity share is 1 naira. As he creates a premium, yes, I issue it at the market price of 6 naira, and it was 1 naira. So 6 minus 1 naira will give me 5 times the share premium, the share issued will give me the premium. But I don't need to do this one in exam because I don't have the luxury of time. What do? I will just say 307,200 minus 51,200 to give me 256 because it is 2 credits against 1 debit according to IFRS 3 business combination acquisition method. Now, it has not been recorded. I will credit. But I have not the investment. The next thing before I go, I will open all the accounts down. All the accounts, I will open it down. I've tested the cost of investment. I have known the good structure. I will now open all the accounts. This thing I have done, you have to do it with calculation, your calculator within 1 minute in the exam. Within 1 minute or 2, oh, okay, I've known the group structure, the share acquire, You just be pressing calculator. So you will know that, okay, you are going to open everything. You must open everything and open it wide. Now, what do I mean by open everything? I will ask, okay, no problem. Page 1, I will say consolidated statement of profit or loss and other comprehensive income for the year ended 30th September 2017. I've written the name on top, Aya. Then consolidated statement of profit. I will say revenue, cost of sales, gross profit. Page 1, I will not do anything, just open it down. It's only one calculation we used to do in the POL, that is the cost of sales. Unless they say I should add certain things to the administrative or distribution cost sometimes. So I will open revenue, cost of sales, I will write it down like that, page 1. I will go to the page 2. I will go to the page 2. I will say, oh, consolidated statement of financial position as at 2017. I will write it down, PPE, property parents plus subsidiary. I will leave it. I will write goodwill. After writing goodwill, I will leave like 3 line space, 2 or 3 line space. I go to current assets. I add it together. I will now say total assets. Equities and liability. I will say share capital, retain earning, NCI. I know it will create a share premium. No problem. I can put share premium or NCI. I put my NCI. The share premium can follow. Or I put my share premium, the NCI can follow. Because I've tested the cost of investment. Now, non-current liabilities, 10% loan note. I will add 96,000 plus 128. Then, current liability, 262 400 plus 150 400. I will now say total equities and liability. To balance this account, I will start from statement of financial position. I will do as if I did not see the POL. To balance this account, I only need 6 things. What are those things? I need the group structure. I will write. I need adjusted return of subsidiary. I will write it out. I will open it. Group structure, leave 3 lines. It's a simple group. Leave 3 lines for the group structure. Adjusted return is your book. Leave 7 lines. Then I go to determination of net asset. I go to determination of net assets. These are what I say you should open down. Group structure, adjusted return, group structure, adjusted return of subsidiary. I open it. I go to determination of net asset of subsidiary. I open the account. Goodwill. I open. I write the formula down immediately. I will write the formula. Then return of the parent. I write it out. NCI, DOC. I write all these things out. If you have an associate, I will put investment in associate. I must open everything. Even though I have not put any figure, I will open it. This group structure, if it is simple group, 3 line is okay. Adjusted return, you have paid for the exam. Your booklet, you have paid for it. Leave like 8 lines. It's your book. Determination of net assets, leave 8 lines for it. Goodwill, leave 8 lines. Return of the parent, leave 8 lines. NCI DOC, leave 8 lines. It's your book. Open it like that, down in the book. Unless you don't know, this is what you use to balance the question. Unless you don't know where you are going to post each one of the question, when you see it in the question, where you are going to post it into the answer. So immediately I've opened it, I will now start. The group structure, 60%. I will fill in the gap. I will start filling the gap. Group structure, parents, 60, NCI, 40. I've increased my mark. I'll go. He said, I've done the cost of investment. He said it has not been recorded. It has not been recorded. When it has not been recorded, what is my own duty? When it has not been recorded, what is my own duty? I will now say, okay, cost of investment, debit to goodwill calculation. Equity shares, credit. Share premium, credit, I'll go up. I've opened the account already. No story. I will just be putting the figure. Equity shares, that of the parent, I take it from a certain financial position, plus the one he created, nominal value, credit, hard, credit, because share capital is like income account. If I'm crediting it, I'm plus into it, plus 200. There was no share premium in the equities, but he has created one as a result of the premium. I create share premium, 256,000, according to the question. Before we proceed further, based on the cost of investment, I give you 2 minutes because we have so many to do to respond to the question. Just 2 minutes. In case you have anything, ask the question. Yeah, 2 minutes. Any issue, 2 minutes. You are in 9:31, so by 9:33. Okay. No question? Okay, let me ask the class. If it has been recorded, what will I do? If it has been recorded, what will I do? You are writing exam very soon and you are professional. If it has been recorded, the cost of investment has been recorded, what is going to be my response? Please shout me. Yeah. Let me see the answer. If it has been recorded, what is my own duty in exam? I give you the question says the share consideration has been recorded. I give you the question says the share consideration has been recorded. What are we going to do in exam? Or it was just silent, meaning it has been recorded. I go to the investment, I see. What am I going to do? Thank you. Somebody has responded. Let me see. So, yay, ignore. Ah. My uncle sister, Similola. No, we are not going to ignore. Ah, ignore about. If I ignore, which one am I going to use? I will pick it from statement of financial position. What are you picking from the statement of financial position? Good. Thank you, thank you very, very much. Mr. Olumide, thank you very much. To use it for the calculation of the goodwill. The other leg will be ignored. The other leg will be ignored. That is what my sister wants to say. The other leg will be ignored. I will pick from the statement of financial position by crediting the investment, meaning crediting investment and debit cost of investment. He has posted the share capital. The share capital you are going to see must be plus 51. The share premium will be in the question. The share premium will have been in the question. The share capital will have been in the question. I only need the 307,200. This 307,200, I will not credit the investment by minusing it because I'm still going to report goodwill. And this figure will be part of the goodwill calculation. I will not debit cost of investment for goodwill. Please always know in exam, you have to ask the question, have you been recorded? And you will see, sometimes they use 3 costs of investment. Sometimes they will put acquisition expenses. So many to it. You are the one to separate which one that goes for this one and which one has been recorded or not. And when it is recorded, you know that you are going to credit the investment in the statement of financial position under non-current assets and debit cost of investment for goodwill calculation. Thank you for following. I love that. Okay, I haven't said that. My goodwill, I'll put it 307,200. Let's go to the goodwill. I'll put the goodwill 307,200. Because goodwill calculation immediately. My mark has increased. After I haven't done that, that's okay. Let's go to the next question. No more information given that is necessary here. He has given market price per share, 60%, the exchange ratio. Then below is the summarized financial statement. We assume all figures to be correct. Now go to the additional information. Additional information 1, at the date of acquisition, fair value of lower limited asset were equal to the carry amount with the exception of item of plant, which had a fair value of 64 million in excess. 64 million, don't forget the account is perturbed by 30, so we have 64,000. In excess of the carry amount and add a remaining use life of 5 years as at that date, using straight line depreciation method. Lower limited has now adjusted the carry amount of its plant as a result of the fair value exercise. Now, fair value adjustment, it will only happen in 2 ways, my brothers and sisters. Fair value adjustment will only happen in 2 ways, my brothers and sisters. 1, the first one is that revaluation surplus or deficit. If it is revaluation surplus, excess, below, how can I know revaluation surplus in exam? They can say it categorically the way they are saying it now. It's equal to the with the plant in excess of the carry amount. They will give you in excess, above, exceed, is a surplus. That is one way. Second way you can know is that they will give you the carry amount and the fair value at the date of acquisition. When the fair value is greater than the carry amount, it gives us what? Revaluation surplus. The fair value is greater than the carry amount, it gives you the revaluation surplus. Third one, they will only give you one item, one line. They will give you an aggregate. The PPE had a fair value of so. They will just tell you he had a fair value of so. You will not compare with the carry amount in the book. You compare what is the PPE here, 403. Let's say they will just say the fair value of PPE is 450,000. They will just put it to you like that. You are the one going to check with the PPE here and compare it to the one they give you, whether it is surplus or deficit. The same situation also applies to deficit. So what is the accounting treatment? What is the accounting treatment? Let's see. What is the accounting treatment? It has been analyzed here, fair value adjustment, where to debit and credit. It is only 2 ways. It's either it is revalue of fair value or revaluation deficit. If it is surplus, my asset has increased, I will debit. If I'm debiting an asset, that means I'm adding to it. I will not credit the reserve with the figure 64. Now, if it is revaluation deficit, PPE, it has come down. My boy, my carry amount that I have in my book, when they say, oh, you don't go and do the valuation, it's below what you have in your book. It's deficit. It has come down. I will credit the PPE, meaning minus it from the PPE to bring it to the value that's supposed to be. I will not debit the reserve. That means the net asset we declare is lower. Then the depreciation, if it is valuation surplus, the depreciation is the PPE surplus. I've undercharged myself for depreciation. The remaining one I've not charged, I will credit. Who is the owner of the asset that does not charge depreciation correctly? Subsidiary. I will now say adjusted the TNO of the subsidiary, I will debit his account. Opposite is deficit. PPE, I will debit because I'll be overcharging myself initially. My return, I will credit that, okay, in my POL, I've removed my depreciation there. I will credit back to my account. The subsidiary will credit. Then, according to the question now, evaluation surplus, 64,000, debit, reserve, credit, depreciation on it, depreciation. They've given me useful life for 5 years. I'm only consolidating for 6 months. Date of acquisition to date of consolidation is just 6 months. 6/12 64,000 divided by 5 and 6 over 12. It will give me 64. What do I do to the 64? PPE, credit. Credit. Adjusted return of the subsidiary, debit. Now, let's go to this thing we have said now, please, so that you can see. I would immediately have gotten this. In exam, I don't need to say debit, credit. I don't have the luxury of the time. I know what to do. 64, valuation surplus. I'll go and add to the reserve. PP plus 64. The depreciation minus 64. Credit. I will go down again. My reserve, net asset, at the date of acquisition, net asset are just 5. And it is very hard, you see question that will carry the 5. According to IFRS 3, net asset are just 5. Share capital, share premium, retained earning, revaluation surplus that happen at date of acquisition, or the one he has in the book. Then other component of equity. Net asset are just 5. Other component of equity. Revaluation surplus, say credit reserve, 64. Then the depreciation, adjusted retain any of the subsidiary, I will debit his account. Depreciation, 64. I pick the figure as per SOFP, state of financial position. What is the retain? 208,000. Depreciation of 64. That is what he said. So let me take you back to the additional information 1. So any issue, ask question concerning this. Is there any issue? Let's ask question concerning this. Is there any issue? Yeah, let's ask question. Just in 1 minute or 2. Let's ask question. Let's ask question. Okay, if there's no question, we go to the next one. So you have 2 minutes to ask question. Question 2. Additional information 2. Sales on lower limited to higher limited. In the post-acquisition period, we are 256 million, 256 million. Now, you cannot sell to each other because you are a single entity. From the definition of the group account, is account of the parent and subsidiary prepared and presented as if they are one. 256 million total sales. Intergroup sales must be eliminated. Lower limited made a markup of what? On cost, 40% of these goods. Higher limited had sold 166.4 at a cost to higher limited of these goods by September 30, 2017. So the total sales is 256. He has marked it up by 40%, but he has sold 166.4 million. 166.4 million. Out of that many, 256. That means there is unsold. For me to know there is unrealized profit on inventory, certain things must be happening. There must be what? Element of unsold. That is 1. 2, there is element of profit. How do I know there is element of profit? 3 ways. We have, you hear markup. Markup is always on cost. Margin always on sales. And you will hear the formula 1. Before you go to the exam, you will see the 3. Now, let me show you. I will now ask the question. I haven't done that. And that's okay. Additional information 2. Unrealized profit on inventory. There must be element of profit and unsold. If there is a markup, margin, or it has the formula 1, and it has been sold, what am I going to do? I'll go away. I'll go to the next one. It has been sold, no unsold. If there is unsold, but there is no element of profit, the way he bought the goods, he does not add any markup or margin on it. Please always take note of that. Now, having established there is element of profit because there is a markup. Total sales was 256, markup of 40%. Sold, he said you have sold this. Then the unsold will now be 256 minus 1664, which is 89,600. The unrealized profit on inventory will now be 40 over 140 times 89,600, which is giving us 25,600. I will now ask, who is the seller? I will debit the account of the seller and credit consolidated inventory. But subsidiary is the seller, lower, is sold. I will debit his account, 25,600. Consolidated inventory will be credited, 25,600. That is it. Now let me show you the post. Let me show you the post. Let me show you the posting. The seller, I will debit his account. Debit the account of the seller. Who is the seller? Subsidiary. Unrealized profit on inventory. I will debit his account. I will not credit consolidated inventory. I will not credit consolidated inventory. But there is no inventory, there is current asset, which is part of it, minus 5,600. If I'm crediting inventory, what am I doing? Removing from it. On that note, additional information 2 is gone. This is how I'll just be picking it in the exam. It will not allow me to miss. I will get to destination very fast. So any question, please ask question. Ask question. Ask question. 2 minutes to ask question. You have 2 minutes to ask question, 9:50. In the absence of no question, I go to the next one. They say other than where indicated, profit or loss items are deemed to accrue legally on a timely basis. What do they mean? That profits can be prorated, they accrue constantly. They make each profit every year. It's not seasonal, it's not otherwise. Please always take note of this. They will put it there, especially when it is doing the year acquisition, where retaining will not be given. That you can prorate. Now the next. Now lower limited trade receivable at September 30, 2017 include 9.2 million due from Ayaya Limited, which is not agreed with Ayaya, which is not agreed with lower limited corresponding trade payables. This was due to cash in transit. There is a cash in transit from the Ayaya Limited to lower Limited. Both companies have positive bank balance. Now, trade payable and trade receivable reconciliation balances. It can only happen in 3 ways in exam. It's just only 3 ways. No more. 3 ways. Now, out of the 3 ways, I will show you the 3 ways. We will now pick one of the 3 ways that this question is talking about. Let's go. We will see now. Out of the 3 ways, Formation 3, trade receivable and trade payable reconciliation. They both agree to the owing, no cash in transit of any kind. They both agree to the owing. No cash in transit of any kind. What can be in transit? Cash and inventory. How can inventory be in transit? You have a subsidiary in Kano and the head office is in Lagos. You now said, okay, send me goods in Kano. Before even the goods leave the company in Lagos, I would have removed the data from the stock by crediting stock to remove the level of the stock that we have sold this. So we remove it even before you get to its destination. So inventory can be in transit. So cash and inventory can be in transit. But if both of them agree to the owing, no dispute. Parent says you are owing me 10,000. The subsidiary agree to it, to the owing. Or subsidiary say you are owing me. Parents agree to the owing. They both agree to the owing, no disputes. They cannot owe each other because they are a single entity. I will credit trade receivable accounts and debit trade payables accounts. They both agree to the owing. Don't owe each other. If I'm crediting trade receivable, what am I doing? Minusing. And if I'm debit trade payable, what am I doing? Minusing, because trade payable is a credit balance account. Then, second one, full of the amount is in transit. The parent or subsidiary say you are owing me, say yes, no. I've transferred all the money I'm owing you yesterday. But he has not reached the other person's account. Trade receivable, you credit. Cash bank, the money is coming back to the system. You debit by adding to it. But part in transit, which can be cash or inventory. Trade receivable. You say you are owing me 10,000. Say no, I've paid 7,000. I've transferred 7,000 yesterday. I will credit the 10,000 minus 10,000. The one that is coming in cash, I will debit 7,000. I will now eliminate 3,000. 10,000 minus 7,000 will remain 3,000 to be eliminated in trade payables. That is it. Nice. According to the question, trade receivable cash of 19,200. Cash in transit must be debited. 64. Trade payable 12,800. According to the question now, credit trade receivable 19,200. I will go. In my statement of financial position, the cash plus 6 trade receivable minus 9,200. How much am I eliminating now? He has transferred 6 into the place. Plus 6 minus 9,200 is the balance, 12,800 they are owing. This 6 is not part of the OE anymore. The difference is what I will now eliminate the coin liability, which is trade payable, minus 12,800. Please know that. That is the 3 ways it can come in exam. That is the 3 ways it can come in. Oh yeah, 1 minute to ask question. Okay. IIR Limited has a policy of accounting for non-controlling interest at the fair value. For this purpose of fair value of the goodwill attributed to non-controlling interest in lower interest is 48 million they've given me. Anytime they're giving you goodwill attributed to NCR, they've given you to pay penalty without the keeper in front of the post. meaning you can do it the way you like. Why did they give me goodwill attributed to NCI? It shows it is fair value. You all know that NCI can be valued in two ways. It's either it is fair value or share proportionate. If it is fair value, how do I know in exam? One of these four must be there. If it is fair value, one of these four must be there. Market price per share of subsidiary or NCI will be given in the question. Market price per share of subsidiary or NCI will be given in the question, which is showing it is fair value. 2, fair value given directly in the question, they will give you the value of the fair value. 3, the fair value of the whole subsidiary. The fair value of the whole subsidiary will be given in the question, which I will multiply NCI percentage on the fair value of the whole subsidiary. Then 4, goodwill attributed to NCI, like this one, goodwill attributed to NCI. But if it is share proportionate, we only attach to net asset. The NCI only attaches to net asset only. That is why sometimes they call it net asset method. You have to share the net asset based on the group structure between parent and NCI. It can only be known in two ways in exam. When the question is silent. What do you mean by the question is silent? You will not see anything of fair value in the question. All the conditions for the fair value, one of them will not be in the question. You will not see anything. That means you have to use share proportionate. And secondly, company policy. Company policy, when there's a company policy, meaning you will see one of the conditions for fair value. But the question will not tell you is the company policy to use what? Share of proportionate. Company policy will now supersede the fair value. That's what the standard says. If the management decides that, oh, let us be using share of proportionate instead of fair value. Now let's go further. You now see the goodwill got in using fair value approach. That means NCI is value at fair value approach. The goodwill belongs to both the parent and NCI. That is why you are seeing goodwill attributed to NCI. It's fair value. Goodwill, not controlling interest. It means the goodwill you are getting using fair value approach. The goodwill you are getting using fair value of approach to value NCI belongs to both the parent and NCI. The one of the share proportionate, the goodwill belongs to what? Parent only. Now, always know, even in fair value, the goodwill of the parent is share proportionate. Always know that. Even in fair value, the goodwill of the parent is share proportionate. So one of the difference between fair value and share proportionate is that NCI in fair value qualifies for goodwill. He also qualifies to share the net assets based on the group structure the NCI has. He qualifies for goodwill, part of the goodwill will be given to him. He also qualifies for share of the net assets. But if it is share proportionate, NCI does not qualify for goodwill, no goodwill. It is only qualified for net assets. So in fair value, NCI is entitled to two things: goodwill attributable to NCI and share proportionate. And the net assets, we share the net asset. But if it is share proportionate, NCI only qualify for one thing: net assets only. Okay. So which I will be demonstrating to you now. Okay. Now you have given me goodwill at the date of acquisition. Goodwill attributed to NCI at the date of acquisition to be 48 million. I will write that out by saying goodwill attributed to NCI 48. I have known the cost of investment. They've given me goodwill attributed to NCI, but it remains the net asset to be shared together with this. How do I determine the net asset if I don't determine the retained earning? Now, they will not give me the retained earning. We have read every adjustment, no retained earning. They will never give me the retained earning. Why? because it is during the year acquisition. I will not determine the return using the formula. They will not give you return. When are you going to apply this formula? When it is during the year acquisition, you have two ways. The determination of the return of subsidiary at DOA. Now, the return earning at the date of acquisition plus year-ended profit or loss. Which profits did they make during the year? That year equals to return earning statement of financial position. The POL is here under year-ended profit or loss. Mistake. Return and date of acquisition is we don't know. I want to know. Year-ended profit, they make 96,000 according to the question. Where do I see 96,000? They're giving me POL. That is why we are saying profit or loss. Is that how they give me POL or they stated it in word? $96,000. They've given me POL. I only entitled to 6-month profits. I will remove the post. 96,000 times 6 over 12. Remove the post because you only acquire, you only entitled to 6-month profit, post acquisition profit of 6 months. If it is acquired for 4 months, remove 4 months. Equals to 208. I will now say 96,000 times 6. 96,000 6 over 12 will give me 48,000. So y will now equals to 208 minus 1 by collecting in lifetime. Y is now equals to 160. Y is now equals to 160. 160. So Y is 160. That means I've got my return and date of acquisition to be 160. Alternatively, you can decide, okay, what is the return instead of financial position? 208. Remove the profit for the year to bring it at the beginning. As at the beginning of the year, this is what they will have before they start working. He has 112 as at the beginning. This is the return any brought forward at the beginning of the year, 112. I will now correct this one, pre, is the pre you will put to profit for the year, 96,000 times 6 over 12. Pre, no post again, no, pre. If the pre is 4, he acquired for 8 months, I will use pre for this one. No, that's the difference. No. It will now give me 48. I will now add the 48 plus this to give me the 160. With this now, I cannot get my retain earning at the date of acquisition. Retain earning at the date of acquisition. Retain earning at the date of acquisition. In my net asset. Where is my net asset? Let's go there. 160. That's why you get your retain earning at the date of acquisition. 160. I will now sum everything up. If I sum everything up, it will now give me 352,000. That is the net asset at the date of acquisition. This 352 belongs to both the parent and NCI. They've given goodwill attributed to NCI to be 48. Now, add NCI. How did I get this NCI of 188? He has 2 things to take because it is fair value. They've given goodwill attributed to NCI to 48. 40% of 352,000 because he needs to share part of the net asset. I will now add it to the goodwill attributed to NCI to give me all this 188,800. Let's go there and show you. NCI at the date of acquisition now. Goodwill attributed to NCI, 48,000. NCI percentage of the net asset at the date of acquisition, 0.4 times 352, 148,800. Summation of the two. This is what they call, in some question, the fair value of NCI equals to 118,800. This is the fair value of NCI. If you are in a class now, I will have been demonstrating everything to you. This is the fair value of the NCI. With this question now, I can know the market price per share of the subsidiary or NCI. I can know the fair value of the whole subsidiary. Get this too. The goodwill attributed to NCI 48, NCI percentage of the net assets 352. Addition of the two will give me the fair value of NCI given directly from the question. This is how they get the fair value of NCI. So I will now add it to the cost of investment. What is the cost of investment? 307,200. 307,200 cost of investment. Plus the goodwill, add NCI, which is the goodwill attributed to NCI and NCI percentage of the net asset. To give me 496. I will now less the net asset date of acquisition, which is 352. The goodwill at date of acquisition is now what? 144,000. Alternatively, I can get the goodwill of the parents, add it to the one they've given me in the question. Goodwill attributed to NCI. I can get the goodwill of the parents, add to the one they've given me in the question to get it. Alternative to goodwill calculation. Now, I will use share proportionate to get the goodwill of the parents. Because I told you, even in bear value, the goodwill of the parent is share proportionate. Even in bear value, the goodwill of the parent is share proportionate. I will use the share proportionate to get the goodwill of the parent. I will now add it to the goodwill attributed to NCI they've given me in the question. How? Look at it. Cost of investment, I will use share proportionate now. 302. Add NCI share proportionate. 0.4 times 352. 148,800 for shares consideration. I will now less the net asset date of acquisition to be 352. He has given the goodwill of the parents 96,000. And they've given me that of the NCI in the question. I will just say the goodwill of the parents plus that of the NCI will now give us total goodwill of 44,000. The same thing as the one above. I did not understand. Even understanding is not even understanding me. I'm struggling to get it. Because it is not negotiable, you must pass. Me, I want to drink wine of success. You must drink wine to appease the God of Icon. Oya, talk, ask question where it's not clear. Good. Retain a DOC. We have not gotten to retain a DOC. We have not gotten to the retain a DOC. Please, I would like to reconfirm. Reconfirm what's ma. That part is not clear to me. Reconfirm. What do we need it to confirm? Please. This question. Reconfirm. How do we reconfirm? Madam Sumisola Ogunshola, please. Do you confirm? What can we reconfirm so that we can answer the question? Or I should recap. Always know this at the back of your mind, ma, that the good we got in using fair value approach in value NCI belongs to both the parent and NCI. Belongs to both the parent and NCI. Now, belongs to both the parent and NCI. NCI when it is fair value, NCI is entitled to two things. Goodwill attributed to NCI, one, and NCI percentage of the net asset at a date of acquisition, at date of consolidation. Is entitled to that, no story. Now, having said that, yes, the seller, irrespective, if subsidiary is the seller, go to the adjusted retained of the subsidiary, debit is retained. If parent is the seller, debit the account of the seller, retain of the parent, seller. Some people used to share it if subsidiary is the seller. You are wasting time. There is no time. You will still arrive at the same question answer. You will see some textbook when subsidiary is the seller, they will not take the percentage of the subsidiary, percentage of the NCI and the parent to share because he's reporting the profits. Okay, the unrealized profit you are not seeing in the calculation is there, man. Let me take you there. Unrealized profits. Unrealized profits. Subsidiary is the seller. Unrealized profit on inventory. Unrealized profit on inventory, 25600. I will not credit consolidated inventory minus 25600. I hope it is similar because subsidiary is the seller. So that is that on the goodwill attributed to NCI. Okay, having said that, so goodwill attributed to NCI, that is that. They've given me, I'll get that of the parent because I know even in their value, the goodwill of the parent is share proportionate. The goodwill of these parents can only be gotten in shorter form. Look at the shorter form of it here. Oh, no shorter form of it here. I mean, it's a subsequent question. You will see the shorter form. When you remove 60% of the net asset by saying 0.6 times net asset from the cost of investment, it will just give you 96,000. The shorter form of cost share proportionate of the parent by saying 0.6 times what is the net asset 352,000. Anything they give you, remove the cost of investment, remove it from the cost of investment. I will now say 307 200 minus answer. It will give me 96,000. Straight, the shorter form of it, which I will show you. Okay, having said that, with this, I can now determine my NCI value at the DOC. Adjusted return of the subsidiary. I will now go adjusted return of the subsidiary. The share does not change unless there is a bonus issue 128. I'll go to the adjusted return of the subsidiary. Depreciation, subtract 64 bracket is there. Sorry with that. Then 2 by will give me 176,000 because we debit it. It's a surplus. We debit. Do not give me 176,000. The 176,000, I will not break it down to the DOC. Retain at DOC 176,000. I will not minus DOC minus DOA to give me 16,000. Is the 16,000 they're going to share based on the group structure? I'll go to the return of the parent as per SOFP. This is the return earning. I will share the profit 0.6 times 16,000 to give me 114,400. Then NCI DOC, date of acquisition. These are NCI, which is what the goodwill attributed to NCI and net assets. is percentage of the net asset at date of acquisition. Then the share of profit. Alternatively, because you know that it's only two things you're entitled to. As DOC, you're entitled to the percentage of the net asset at DOC plus the goodwill attributed to him. I will now say it's 0.4 times net asset at DOC. What is the net asset at DOC? 368. 0.4 times 368. We give him 147,200. Plus the goodwill attributed to NCI, 48. You will give him 195,200. The same. Anyhow you want it. It means in exam, you can decide not to even open NCI accounts. So far you know your net asset at DOC. You will just multiply the percentage plus the goodwill attributed to it. That's all. But you must know how to get your goodwill attributed to it in case it was not given, which I will show you in the next question. So my NCI at the date at DOC is 195,200. The retained earning will be reported. With this, I cannot balance my book. With this, I cannot balance my book. With this, I cannot balance my book. I'll go to statement of financial position. $195,200 to calculate the goodwill. Okay, NCI. To calculate the NCI is two ways. How do you know how we arrive at 188,800 goodwill attributed to NCI 48,000 at the date of acquisition plus NCI percentage of the net asset at the date of acquisition? Then we share the profit to him 0.4 times 16,000 to give me 64. We share the profit to him. The profit post 16,000 times 0.4. But alternatively, NCI DOC can get the NCI percentage of the net asset DOC. 0.4 times net asset DOC is 368,000. It will give me 147,200. Plus the goodwill attributed to NCI, 48,000. The same is allowed, any one of the two. If you know this one, that means you don't need to open NCI account in exam. In short, when it is share proportionate, this is what I will just report, because if it is share proportionate, there is no goodwill attributed to NCI. I will just say 0.4 times 368, 147,200. So that's what I will report. I will not open NCI accounts. Okay, this is now. I haven't done that. I will just substitute everything into my question. Statement of financial position. I will just substitute everything into my financial position. The PPE of the parents, plus the sub, plus the valuation surplus minus the depreciation, give you this. The goodwill got in 144. Current asset of the parent plus the sub minus unrealized profit on inventory plus the cash in transit minus the trade receivable you give to it, give you 612. Addition of the three will give me this. Then the equities, the share capital 320 plus the one that arise as a result of issuing the shares, additional equity shares 200 will give me 371,200. Retaining. Okay. Okay. The retaining 114,200 by saying retain as a SOFP of the parent plus the share of post. NCI at the date of acquisition, share of profit, or NCI percentage of the net asset at the date of consolidation plus goodwill attributed to NCI will give me 952. The share premium comes as a result of share exchange. Then the loan, 10% loan note, 96,000 plus 128 to give me 244,000. Then the current liability, 246,400 for the parent plus that of the sub minus that intergroup trading owing 12,800. Giving me 400,000. Please ask question in the next 2 minutes. Let's go to the POL in the next 2 minutes. A minute, please. Sorry for the break in transmission. The broadcast is Gary. My question is, it does not give us the very figure. It's a process. The two will give you the same total goodwill. Total goodwill. My question is, why do you use 95,200 to calculate the goodwill? I did not use 95,200 to calculate goodwill. No. That is the value of the NCI reporting date, DOC, 95,200. How do you get this 95,200? I said when it is fair value, NCI, goodwill attributed to NCI. Because it is fair value, they have two things. A goodwill attributed to NCI and NCI percentage of the net asset date of acquisition. If it is DOC, NCI percentage. Now, what you are saying, get the scope very well. What you are saying is this. Look at it. What you are saying is this. 188,000. This 188,000. What make up this 188,000? Goodwill attributed to NCI. Goodwill attributed to NCI, and NCI percentage of the net asset at the date of acquisition. That is what they call the fair value. They've given you goodwill attributed to NCI to 48. The fair value of this NCI will now be 48 plus NCI percentage of the net asset. Where is it written? It's the same thing. Don't any two of the two ways is allowed. You get the same answer. No questions. Okay, wherever I can see it, I'll show you. Goodwill, how do we arrive at this 188 we use here? 188. They've given me the equation goodwill attributed to NCI to be 48 million. I will now multiply. It's entitled to 40% of this asset. That is what they call fair value. Some question will just say the fair value of the NCI is 188,000. How do they get fair value of NCI? NCI entitled to two things. They will help you to done that. In short, how do they get the fair value? You multiply 188,000. This 188 is at fair value. 0.4 times 352 minus 188, it will give you 48 million, which we will soon very soon. When we get to the next question, you will also see it. It's the same approach it will give you. Now, I'm not telling you that to calculate goodwill in the parent, you can use your proportionate. If you immediately get out of the parent, you add it to the one they give you, it will give you the same answer, total goodwill. To get the approach very well, it's very simple. So immediately I've done that. Okay, I've gotten my what we call it, state of financial position intact. I will go to the POL. It's only one thing they use to calculate in POL, which is the cost of sales. Which is the cost of sales. Now, the revenue of the parent plus that of the sub times 6/12, because I only entitled to 6 months revenue from this. I only acquire for 6 months. Minus intergroup sales, you cannot sell and make profit. You cannot sell to each other at all. Intergroup sales must be eliminated, minus intergroup sales to give us this. I will now go to the cost of sales in the question. The cost of sales. Parent cost of sales. Subsidiary cost of 2 times 6/12 minus intergroup sales. Depreciation must be added because to go to the cost of sales to reduce our revenue. Unrealized profit on inventory, you add it to reduce the revenue. So everything you get is 2,304,000. I'll bring it up. To get the gross profits. Then distribution cost of the parent plus 6,000 times 6/12, 96,000. Then administrative expenses. Then finance cost, the same thing. I will not get profit before tax. Then I'll remove the tax elements to get this. This will now be shared between two of them. Profit attributed to NCI parent. How do you get the profit of the parent and that of the NCI? Go to the POL, profit of the subsidiary, 96,000. I only entitled to 6 months profit, accurate 96/12 to give me 48. What are those things subsidiary did wrong during the year? Depreciation does not charge very well. I remove from the profits. On the last profit on inventory, it will still give you the post that you share 16,000. Unless there's an application of accounting standard, sometimes, but majority of the time, you should give you the post. I will now say 0.4 times 16,000 to give us 6/4. The 304, I will bring it down. Then the parent is balancing figure. 304 minus 6/4 will give me 297,600. That is that. Now, let's use 1 minute to attend to question so that we go to the next one. 1 minute to attend question. 1 minute. 1 minute to attend to question. Oh yeah, 1 minute. One minute. Now, in the absence of no question, go through this thing. My number is part of this mullet. You will see it as part of this group. Is there any question you want me to attend to? You can ask here. Or is there anything you can even call me? But don't do video call at night so that you will not see what you are not expected to see. Now, anytime, call me, we can discuss this question. So let's go to, because of our time, let's use the remaining time, 30 minutes, to go to the second question, which is DSTV and GoTV. Can you hear me now? Yes, yes, yes. It's back on.
I hear you clearly.
Ah, oh, this network. Ah. Sorry for the break in transmission. It's due to network. Can we extend this class by 30 minutes due to the network issue? Prof, can we extend this class by 30 minutes due to the network issue? Can we extend this class by 30 minutes due to the network issue?
Okay. Will the 30 minutes begin from now? Or you want us to end by 11:30?
11:30, 11:30, 11:30. Huh? Is it agreed to?
Probably, let's make it 15 minutes. Let's make it 15 minutes. Sir?
Okay, 11:15, Abi.
Let's make it 15 minutes. That will be 11:15.
Okay, okay. No problem.
Thank you.
No problem. Yeah, minimize. Okay. Okay, so you can hear me as well, Abi. Now let's quickly consider this question, please. Any length we can go, we will try. Amanda, you want to write the exam? Oh, I'm dozing already. Don't doze you. Okay, on April 2007, DSTV. On April 2007, DSTV acquired the following non-current investment: 6 million equity shares in GoTV by exchange of 2 shares in DSTV for every 4 shares in GoTV, plus 1.25 per shares acquire GoTV shares in cash. It used 2 costs of investment, share consideration, and plus 1.25 per shares acquire GoTV shares in cash. So he used 2 costs of investment, which is share consideration and cash payments. Now, it must be issued at the market price of the parent. And the market price of each DSTV share at date of acquisition was 6 naira, and the market price of each GoTV shares at date of acquisition was 3.25. I need only the market price per shares of DSTV, 6 naira. Why are they giving me market price per share of GoTV? Who can tell me the reason why they give me the market price per share of GoTV? Who can tell me the reason why they give me the market price per share of GoTV? Why did they give me the market price per share of GoTV? Good, somebody has replied. 2 people. To confuse us. To determine the share premium. God will surely bless you, Olajumoke. NCI is an indication for me that NCI is value at fair value. We said, how can NCI be value? NCI is value in 4 ways. In one of these 4 ways, you will see in the question, market price per shares or subsidiary or NCI. That is 1. 2, fair value of the whole subsidiary. 3, goodwill attributed to NCI. 4, fair value given directly in the question. They've given me market price per share. There's no story. This is an indication it is fair value. I will just quickly run to the additional information to confirm this thing. They will tell me, okay, let me confirm what I'm saying. Say, okay, 32.25. Why? DSTV has the policy of value not controlling shares as fair value at date of acquisition. For this purpose, the share of price of GoTV at this date should be used. Please, you must ask the question, not the question asking you question. Okay? I haven't said that. He acquired 6 million shares. Out of how many shares? 8,000. What is the nominal value of the shares? 1 naira. Therefore, 6 divided by 8 times 100 will give me the group structure. 6 divided by 8, 6 million, divided by the 8 million, times 100 to give me the group structure. How many shares does he acquire? 6 million. Okay. What is the exchange ratio? 2 shares in DSTV for every shares in GoTV, 2/4. Times the share he acquired, 6 million, to give me the additional share issued as a result of share exchange, which is 3,000. What is the market price per share? 6 million. Let me show you. The market price per share, 6 million. The group shows us 75%, NCI 75%. How do we get that? Okay. This is it, working. Date of acquisition to date of consolidation is 1 year. Values of shares, 8 million, divided by the nominal value, 1 naira, 8 million. So he acquired 6 million out of 8 million times 100 to give me 75%. So parent is 75%, NCI is 25%. 2 costs of investment is used, share consideration and cash payments. For the share consideration, say 2/4 times 6,000 equals to 3,000. They've given me the market price of the parent, market price per shares of parents, 6 naira. Cost of investment, 3,000 times 6 naira, 18,000. Equity shares, 3,000 times 1. Share premium, 15,000. Not recorded. According to the question, he says it has not been recorded. According to the question, he says it has not been recorded. It's okay. %30 equity shares in Big Brother at a cost of 75 points per share. Only the cash consideration of above investment has been recorded. Only the cash consideration recorded by DSTV. In addition, 1 million of professional costs relating to the acquisition of GoTV is included in the cost of investment. They've included. That is wrong. It must be expense. All acquisition expenses. Acquisition expenses are 2. The one that related to issuing costs and others, like professional fee, legal fee, additional costs, all those ones are others expenses. So acquisition expenses are 2. Professional fall under related. Issuing costs, Those ones are related to the issuing costs. And what do we do to all acquisition expenses? Must be expense. By crediting your cash, you pay for acquisition expenses. You debit retain any. But if it is issuing costs, related to issuing costs, you debit the share premium to remove from the share premium. But if it does not have share premium, you debit retain any to remove from the retain any. I will explain more on that. Okay. The cash has been, share consideration has not been recorded. He said the only cash consideration above investment has been recorded. Only cash. This is cash. This is cash. Now, he has recorded it. Where is he going to record it? That's why I said investment in GoTV and Big Brother. He has told the specific instruction. Investment in GoTV and Big Brother. He has recorded 26,500. So I will now go and calculate the cash by crediting this and debit cost of investment for goodwill calculation. But for the share consideration, it has not been recorded. I will record it by taking the market price of the value issued to cost of investment, the equity share credited, the share premium credited. But if you look at the question, there is no share premium. You only have equity shares. I will credit equity shares 20 plus the equity shares of 3,000. Then the share premium I will create it, share premium account. So look at it. It has not been recorded. Then for the cash payment, he acquires 6,000 shares times 1.25 is paying 1.25, which is 7,500. Recorded. I will not credit investment, and debit cost of investment for goodwill. So the total cost of investment will now be 18,000. Total cost of for the share consideration 18,000, for the cash payment 7,500. Now for this one, credit investment. I'll go to the investment. Look at the investment. In the non-current assets. Where is the non-current assets? Investment in GoTV minus 7,500. Then he acquired 30% in associates. Let's see the 30%. 30% in associates. Let's go to associates. He said 30% investment, paying how much? 30% of equity shares of Big Brother at a cost of 750 per shares. What is an associate? Investment that range from 20% to 50%. It must be recorded at cost. That is why I record it at cost. But because me, I'm reporting investment in associate, know that we don't consolidate associate. We don't add associate to it. We only report investment in associate. We don't consolidate associate because it does not have control. Unless it's a de facto. It does not have control. What do I do in this regard? 30%. Okay. How much does he pay for each one? He acquired 30% shares. I will now say, okay, what is the total numbers of shares? What is the total numbers of shares? Okay, let's go. The shares he has in Big Brother. What is the total shares in Big Brother? I'll go and look. Total shares in Big Brother is 8,000. What is the nominal value? 1 naira. 8,000 divided by 1 naira will give me what? 8,000. How many shares does he acquire in Big Brother? 30%. 30% times 8,000, 24. How much does he pay for each one of them? 7 naira 50 kobo. 7 naira 50 kobo times 24 will give me the what? The cost of investment in associates. Look at it. Investment in associates. Total numbers of shares. Total numbers of shares in associates. Values of shares all over nominal value. 8,000 divided by 1, 8,000. 0.3 times 8,000 because 30%. 24. 24 times 7.5. 7.5 kobo 18,000. Recorded. Credit investment, 18,000. And debit cost of investment in associate, 18,000. That is what the rule says. Okay. I'll go to this investment. Look at the investment. Credit investment minus 18,000. Acquisition expenses of 1,000 has been reported here. Acquisition expenses as reported in investment of 20,000. And I say, okay, acquisition expenses of 1,000. It will go to the retainer of the parent because it does not related to what? Professional cost of 1,000. He said he has included it. I will debit the retained earning. But if it related to issuing costs, get the facts, you must be taken for the share premium. But if there is no share premium, you not debit retained earning. According to IFRS 3, acquisition expenses. Okay. Now, I will not credit has been recorded. Normal, what is the entry for acquisition expenses? Let's assume it has not been recorded. I want to record it. It does not related to issuing costs. Let's start with that one. I will credit my cash. Cash will disappear. I will not do what? Debit retained earning for it. But this person credits cash, which is correct. He not debit investment. By adding, when I'm debiting investment, what am I doing? Adding to it. That is what he did, which is wrong. Because acquisition expenses must not be part of the cost of investments. They've not tested acquisition expenses in ICANN exam, but it's part of the syllabus. I have sent one to the platform also on the group. Okay, when there is acquisition expenses related to the acquisition, it will not be part of the cost of it. If you are paying your rent, your agreement and commission will not be part of the rent you are going to use. It's a ceremony. The same way you must expense it. It's your own loss. Now, it has been included. If it is issuing costs, you will credit cash and debit share premium accounts because anything related to shares is being financed by share premium. And this one related to shares. What are those expenses that are related to issuing costs? The cost of registering the subsidiary in stock exchange is related to what? Issuing costs. But lawyer fee, all these professional fee, legal, all those, they are not related to issuing costs. If you want to buy a subsidiary, lawyer must be there to cement the agreement. So if it is not related to issuing costs, that's where you're going to do it. Hope that is taken. Any question before we proceed? We have 11 minutes more because they only grant us 15 minutes for extension. Okay. Any question? So in all this course of investment up here, we have done all the three. The acquisition expenses, the associates, the 6 million equity shares plus the cash, market price of shares. Okay. Can we go further and say, okay, let's see. In additional information, okay, at the date of acquisition, the GoTV had their internally generated brand name. Directors of DSTV explained that the brand name has a fair value of 2 million and indefinite life and has not suffered any impairment. There is a brand name at the date of acquisition. That is why after you have opened everything, your goodwill, after writing the goodwill, you will now leave like 2 or 3 line space. Why? Because of this brand name investment property. There are about 3 who can come there. And there's no question can carry the 3. Unrecognized intangible assets by the subsidiary, but it's been recognized by the parents. So don't forget. So what will I do? I will open a brand name account by debiting the brand name account, 2 million, and credit my reserve, 2 million. Look at it. Brand name, credit reserve. Brand name account, debit 2,000, reserve credit 2,000. That is all. I'll go to statement of financial position, the brand name, statement of financial position. No impairment, no amortization. Brand name. Okay. On April 2007, 1st of April, is that the date of acquisition? Yes, the date he acquired. DSTV sold an item. Look at these dates. 1st of April 2007. That is the date of acquisition. 1st of April, he acquired. He now sold item to him. DSTV sold an item of plant to GoTV at agreed value of 5 million. The carry amount prior to this sales was 4 million. The estimated remaining life of the plant at date was 5 years. Net assets at the date of acquisition. Your net assets. Have you seen it? Brand name, credit, reserve. It happens at date of acquisition. Hope is clear. On April 2007, DSTV sold an item of plant to GoTV. Now, on April 2007, DSTV sold an item of plant to GoTV at agreed value of 5 million. The carry amount prior to this sales was 4 million. That means he had made a profit. The estimated remaining life of the plant at date of sales was 5 years. That means DSTV sold. DSTV has made profit on the sales. Because the kind of amount of this is this. You cannot make profit from each other because you are what? A single entity. There is unrealized profit on PPE. Now, what do I do to the unrealized profit on the PPE? There is unrealized profit on the PPE. Selling price is 5 million, the carry amount is 4. He made a profit of 1. Seller's account, debit his account. Seller's account, return of the seller, you debit his account. Then you credit the PPE to bring it down to 4 million. The 1 million credit by removing the money from the seller's account and credit the PPE so that 1 million, because the person that bought it believes he bought it at 5 million. He will carry it at 5 million in his book, whereas he's supposed to carry it at 4 million because you are a single entity. You cannot sell to each other and make profit. Now, what will now happen? But the depreciation, the person that bought it will be charging depreciation on 5,000 instead of 4,000. Will have charged depreciation of 5,000. The useful life is 5 years, which is 1,000. Then depreciation on 4,000, which you were supposed to have charged 5 years to give me 800. That means he has been overcharging himself of depreciation of 200, overcharging. Instead of charging depreciation on 4,000, he's charging depreciation on 5,000. Every year he's charging 1,000 instead of charging 800. Now, instead of doing this in exam to be wasting your time, you just say profit divided by the useful life. 5 years. That's why it will give me the 200 here. I'll be overcharging myself. I will now debit the PPE by 200 and credit adjusted retaining of the buyer, which happens to be the subsidiary. Subsidiary is the buyer. I will not credit his account back. That is why you see the PPE adjusted return of the subsidiary being credited. Depreciation, I credit his account back 200. Then PPE debit. Any question? Any question? Okay. We will continue next week from this question. Maybe we'll start it over again to quickly rush it. Thank God you have gotten so many of it. Then you can go through it. Is anyone you are not clear? I try to simplify all the adjustment one after the other so that for clarity purpose. But in case you are having struggle with it, let me know. Then you can call me, chat me at any time. Call me at any time. You are free. So I will respond to your questions. So any question, let's use the 3 minutes that remain to ask for question. Yeah, ask question on this one that we have done or any group account you think, any question in your group that is giving you problem. Oh yeah, ask within the 3 minutes. Let's ask question. Let's ask question. If you don't ask question, I will ask question within the 3 minutes. Let's ask question. Okay. Oh yeah. Ask question. Okay, if you don't ask question, I will ask you question. Okay, what is the disadvantage of using share of proportionate over fair value? What is the disadvantages of using share proportionate in value NCR? What is the disadvantage of share proportionate method in value NCR? Why the standard recognize that fair value should be almost be used? Disadvantage of share proportionate. That is one. Oh yeah, tell me. Okay, that is a takeaway question. Please, it's a current issues. There's a debate on share proportionate and fair value going on. and they believe that okay, thank you, Mr. Olumide, that the parent company bears the impairment all alone. Shop alone before, must die alone now? No. Because NCI in using shop proportionate is subjective in nature. Meaning by subjective, you can just okay, we will continue for this. They have given me signal that is my time is up. Okay, as you can't hear the class. Okay, thank you very much. I really appreciate. We'll continue from here. But you can shout me or apologize me for any issues. Thank you. See you next time.
You're welcome, sir.